What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is June 26th of 2020. Well, folks, I hope you all are having a fantastic day wherever you are. And in today's video, I want to spend some time to build on a theory that I've had over the last few months, that as we've been entering into this crazy time of infinite liquidity and teetering on the reality of negative interest rates, that what we're seeing right now in equity and asset markets abroad could be the beginning of our roaring 20s here in the 21st century. How we could see not only the Federal Reserve push the boundaries of what is seen as possible in regards to keep asset markets afloat, but also what the FDIC and other financial regulators are going to provide in order to make sure that this machine continues to keep on running and keep on chugging to the upside. So we're going to be talking about all this and more right after our quick sponsor. Our sponsor for today's episode is Bitpanda Pro. If you're on the hunt for a proven, trustworthy exchange in Europe to trade your crypto, then I recommend taking a look at Bitpanda. If you're just getting started, many people refer to Bitpanda as the European Coinbase, so it can be a great place to start in getting your first crypto positions. With over 5 years of experience serving the industry by offering easy and secure access to digital currencies, Bitpanda has really earned its reputation. Check out the link down below in the description for more information. Alrighty, everyone, so let's go ahead and dive straight into it, guys. The general crypto market has not moved too much in the last 24 hours, so I want to go ahead and dive straight into taking a look at the NASDAQ here and talking a little bit and recapping about what we've seen over the last few months since back in March. So we obviously had one of the worst sell-offs in history, one of the biggest stunts to our economy that we've seen since the Great Depression, both in the real world and also in equity markets. Equity markets, again, such as, for example, the NASDAQ, being a broad index for the general tech sector and kind of a lot of the emerging sectors within the economy, went down from 9,800 downward towards 6,600. Again, massive drop here, the fastest decline that we've ever seen in the sense of our history since all the way back since the Great Depression, right? The fastest pace in sell-off. And of course, we've come up and rebounded here and gone back up to all-time highs here, roughly speaking, in the last week. So again, a lot of people are again feeling that disconnect already, and I think many of you might already know, for example, why this has happened. It's been due to central bank liquidity, basically central banks buying up a ton of financial assets, injecting a lot of cash into the system. And that's not just the Federal Reserve doing this, it's the ECB, it's the Bank of Japan, it's all central banks across the world. We've seen the charts here, we've seen what central banks have been doing, and also with the lowering of interest rates, the cost to borrow capital is more accessible, it's much lower. So in this case, obviously assets tend to inflate. But that's just the surface of it, guys, because as we've talked about in the past, and I really do mean this, the Federal Reserve, the system that exists today, right, who has a massive incentive in making this asset bubble, right, continue to go higher, to maintain its value, will do anything in order to maintain it. You don't have to believe in some kind of conspiracy. You don't have to believe in some, one selective group doing this, right? It's, hundreds of thousands, if not millions of people who have an economic incentive for this to keep going. Right? A lot of individuals who have different ways of life and live in various different areas and probably don't always agree with one another. They all share one interest, and that's asset markets going up. They don't really care about the broader economy. They could care probably less about you or I, or maybe put us as a second priority. So how do they go about protecting their net worth? Well, even though many times in the past, regulators come in and they usually set in some form of legislation, sometimes that ends up being good, sometimes it being bad or having harmful effects in the long term. No matter what, it tends to be that regulators come in after a recession or some kind of downturn in the economy, try to put together some kind of, some decent legislation that helps to, strengthen the economy, to set standards so the banks and the financial corporations in the economy don't make the same mistakes they made before and don't take the same kind of levels of risk that they took before. Well, they tend to, about 10 years later, start to pull back those rules in order to keep things going. And this time, I think we're going to see things go to a level we have never seen them go before. So, for example, the first sign here is the change in the Volcker Rule. Okay, so the Volcker Rule is in reference to one of the old Fed chairmen back a few decades ago who actually, just recently passed away this year. But the Volcker Rule is a financial regulation that was established as a part of the broader Dodd-Frank bill. This was, again, a large financial regulation bill that had been passed and stuff in 2010 after the meltdown in 2008. And long story short, the Volcker Rule is a restriction in this case that basically stamps out a lot of risky behavior from commercial banks. Back in 2008, even before then really, it was back a couple of years before the crisis really hit, banks had started to take depositors' capital, and there really wasn't much regulations at the time to a substantial degree on what they could do with that capital. So, for example, if I was, Bank of America, or if I was, Citigroup, some kind of major institution, I could go out and take depositors' capital, and I could go out and I could basically buy up types of financial instruments. For example, I could buy, as they reference in here, a lot of the same things like the CDOs and a lot of the different types of instruments that, again, might have had a very high chance of risk of possibly, completely going under, right? Losing all of my depositors' money, right? And this is what provided a lot of instability for the financial system. In the short term, it provided banks some of their best upside in history. I mean, they'd have every incentive to take risks, because if you allow that to happen, if, for example, these kind of bubbles start to form, it's better, paychecks for the actual banks who are, racking in these profits for their depositors. It's better when you take that excessive risk. The financial system incentivizes it, right? So you basically, again, have this rule that was set in to restrict things like the subprime market building up again and other risky markets. Well, if we take a look here at the FDIC, which is playing a part, the Federal Deposit Insurance Corporation, which is one of the largest financial entities in the world, right? Basically, the insurance policy on most savings accounts throughout the U.S. and abroad through a variety of areas in the world. They're basically talking about allowing for investments in qualifying venture capital funds. So banking entities can allocate resources to a more diverse array of long-term investments in a broader range of geographical areas, industries, and sectors that may be able to access directly. Love how they make that so clean. Basically, they're saying that they want banks to be able to get in on the game of venture capital. The crazy bubble where, we've seen startup companies going towards ridiculous valuations in markets that will likely never be monetized, that likely are probably overvalued. And again, this multi-hundred, if not $100 billion, if not $1 trillion market is now going to receive mass amounts of liquidity. So the startup world and the craze that's already existed in tech is going to get even crazier. So this is very important to take a look. I mean, this is all public knowledge. And now that they're exploring this, we can see this is just one of many ways where not just on a sense of monetary policy, but also basically financial regulation, we can bolster economies, because we just basically start tapering or pulling back all of these standards we set for ourselves. Now, no standards anymore. There's no need for standards, because if the Federal Reserve is going to be the prime liquidity provider in repo markets, if they're going to be the prime liquidity provider when it comes to everyday, everyday loan programs and everyday, financial funnels, or basically pipelines of cash into the traditional system, why don't we just pull back every standard we set for ourselves? Why don't we overflow the punch bowl, have a good party? It's the 1920s, but it's instead the 2020s. It's 100 years later. We're having our roaring 20s here in the United States and abroad throughout the world. And if you thought you saw everything when it came to asset markets and just how crazy it gets, it's going to get even more crazier. Now, again, this is very key to take in mind, because it's not the only thing that's been artificially keeping things up, right? Many people out there think that there haven't been any stock buybacks this year. And quite frankly, yes, stock buybacks have frozen a bit as corporate earnings have started to take a hit. But we still have had over nearly $300 billion of companies taking their own earnings and coming in and buying in their own shares. And if you take a look at the most two recent years here, back in 2019 and 2018, 2018 being the record year and 2019 being the second closest, we can see here we're really not that far off. Just a few $100 billion. So it's things like these that we're making up shortfalls for, where banks, again, as a depositor, right? You have your money in a bank. Now with the removal of possibly of portions of the Volcker Rule, they're going to be using depositors' money. A record $9.2 trillion, and I think that number's actually probably skyrocketed since COVID, probably up towards around $10 trillion. But now, nearly $10 trillion of your savings that's not earning any interest, that's being possibly going to be penalized soon when negative interest rates come in, they're going to use your money to prop up the VC bubble that's been going on for the last few decades. That's right, they're going to use your money, probably without your permission, because when you sign the dotted line, little did you know that if the bank, for example, lives in an environment where these regulations are removed, they can go out and do exactly what they did before. You have no say in it. You have no benefit from these kind of speculative investments. You're always going to get the same dull savings rate. And it's going to be absolutely terrible for the end user, especially if things go bust, right? You're not going to get a bailout. The bank will, though, right? If all their investments go bad, you're never going to see the reward of it, and you're going to be just as penalized as the bank is. Plain and simple, right? And this is the sad reality here of just how artificial our system is. I mean, this is beyond reason. And again, if you guys want to take a look at a general kind of figure here for an estimate on where central banks are going, again, if you thought this was it, that we've seen the craze of central banks, that we're never going to print anymore, this is what central bank balance sheets are looking like. We are expecting here, right? This is the general mark here, right? If you go across, we had about $15 trillion as we started to taper and kind of keep a flat line here on central bank liquidity. And now we're looking very well, and this, again, I think is a conservative estimate. I think we're going straight to 30 trillion over the next 2 to 3 years. What's to stop it? I mean, here's the problem, guys. When you think about it, you're talking about an equity market, like, for example, even just the NASDAQ, for example, right? And U.S. equities. You're talking about a multi-trillion-dollar market, something in the ballpark of anywhere from around 50 to 75 trillion here in the United States alone. And if you're talking about global equities, you're talking about practically doubling that, if not, basically tripling that. So basically, hundreds of trillions of dollars in equities, right? At these peak valuations. The only way you keep this up, only way you keep these valuations up, is if you have mass amounts of liquidity. That capital and credit is instantly accessible and at the lowest interest rates possible. Not so much for everyday consumers per se. Right? That's maybe one aspect of it. Reckless kind of borrowing activities where, banks are now, just basically bringing mortgage rates down to their lowest levels in history, right? All that stuff might be good for the consumer, but the major thing is that they want to make sure that, again, the banks themselves can use people's deposits, that, for example, hedge funds have instant lines of credit that they can go out and buy any type of financial instrument. They can take up risky financial instruments, for example, like the high yield bonds, the junk bonds that they bought, and now the Fed is starting to buy, and basically setting up a position where people are excessively taking risk, and if anything goes wrong, just pass it on to Jay Powell, right? That's the system we live in. So taking this into mind, right, we are at NASDAQ 10,000 right now, right? We are going to see something even crazier. We are already 2 times beyond the valuation of the peak of the dot-com bubble, to put this in perspective. Double of what we were at in the dot-com bubble. But I gotta tell you all, I used to be very confident that NASDAQ 10,000 was going to be the peak. And I really don't know if I can say the same. I really don't know if I can still stand in my own 2 shoes and say that this is going to be it. Makes you go a little bit crazy when you just see the kind of extent and normalization of how things are going to look over the next few years. Because again, taking a look at this Volcker Rule here, right? Allowing investments in qualifying venture capital funds. That's already a tad bit interesting, right? A tad bit on the hey, we're kind of breaking our own rules here, right? What do you think they're going to do after this? Just exactly what the Fed does when it says that it's not going to teeter into negative interest rates, that it's not going to print more money, that it's not going to start buying up equities, that it's not going to start buying up ETFs, just like the Bank of Japan's been doing for the last decade. They do the exact same thing they say they're not going to do. And the thing you have to think about as an investor is if you constantly see someone doing something other than what they say, is you have to think about, okay, if they've done it in the past, they're likely going to repeat it. What's the next thing they're going to do? The FDIC is going to start letting people, banks in this case, buy other complex financial instruments that add a diverse range of exposure to their portfolios, that allow them to have proper risk management outside of just simply holding deposits in an age of central bank inflation. They'll come up with some fancy term like that to basically keep you and I completely distracted, or at least they're going to attempt to, from what's really happening under the hood. And it's sad because people tend, whether it be the media, whether it be the institutions that be, or us as people, we tend to forget When in reality, it's the same process repeating time and time again, and it's going to come back and hit us even harder. So, at the end of the day, you got to ask yourself where your position. Quite frankly, I want to be in an asset class that is, again, much smaller than other asset classes that has multiples of room to grow versus equity markets, which to double are going to require tens of trillions of dollars of liquidity and are going to probably take, possibly 3-4 years to do so at these kind of valuations. So I'm looking for something that probably has an element of risk and growth to it, but at the same time is something traditional, separate from the traditional systems, right? And that's what I think we have here with not only cryptocurrency markets, and I've talked a lot about Bitcoin being that kind of hedge during this time as a broader asset, but as well as that of the altcoin market. I really do believe it, guys. I have no doubt there's an element of speculation to it. There's an element of excitement to it because DeFi and enterprise blockchain and a lot of the categories that make up the valuation of the altcoin market add a perfect mixture of the kind of speculation that would do so well in this environment that we're living in right now where pretty much anything goes. And the second thing as well is, as anything goes, there's a lot of great innovation that's coming on in regards to the DeFi space that is going to start opening up people protection when savings accounts start to penalize them. That's going to start opening up the opportunity for anyone to participate in buying into financial instruments like cryptocurrencies. And along with that as well, so many applications we can't even begin to start to understand. So again, as Bitcoin again has been relatively stagnant here as we've been pushing up sideways again at a similar range here that we've been testing up here for the last few times, we'll have to see here how things go in the short term. But I'm confident about the future and I can't wait to see what happens over the next few months with you guys. But anyways, that's it for the video. If you guys like this video, please drop a like, and I want to hear from you all as well. What do you make of this? What do you guys think the next thing is going to be for, organizations like the FDIC and other financial regulators in deregulating the economy, letting even more craziness go on in our markets? And outside of that as well, what do you think the Fed, the ECB, and the broader central banks are going to do in order to keep this Ponzi going? It's a Ponzi at the end of the day, guys. It's funny. It's ironic that people call crypto a Ponzi. Jesus, I mean, you want to talk about a Ponzi of grand proportions, of constantly guaranteeing there's always new inflows of capital? Take a look at stock markets across the globe. Hands down. They've mastered the system, right? And this is why I don't try to short or bet against the Fed. They know how to do this. And they're going to keep doing it so long as they can keep it going and not face the consequences of their actions. All right. That's it for today's video, guys. I rambled on enough. You can obviously probably tell I'm a bit flustered, but it's something very important to talk about. That'll be realized. I'll see you all soon. I'm going to be heading out here for the next few days, so I'll see you all on Monday in my next video. Stay tuned, everyone.